Hey everybody, welcome to Talkenomics Live. We thought we would do this episode in Spanish, but no, vamos a hablar en inglés. And by the way, we have to do a shout out because the team here, not me, but the others, because I think of ice hockey as basketball, but we have Florida Panther fans in the house, the studio. They're very happy. They're also a little hungover. So the tech crew, there you go. Yeah, the Florida Panthers. They are the Stanley Cup champions, so congratulations. And the tech crew is hungover, but still top-notch and doing their job. So we're going to talk, obviously, economics. There's lots of headlines that are breaking. But first, I just want to share with you, about a month ago, you may recall that we did a My Talk where I went on one of my foot and mouth disease rambling sessions in which I talked about Social Security. Well, guess what just crossed within the last 20 minutes? The actuaries at the Social Security program say that it faces a financing shortfall. Clutch the pearls. Who didn't already know that? But if they don't address it, that means they being Congress, they will have to slash millions of retiree benefits, and they'll do that within 8 years. So if you're expecting 100 cents on the dollar when you retire, which some of us are in the next 10 to 15 years, maybe it's going to be 70 cents on the dollar. That would not be good. Let's see how Congress reacts. The other headline that is breaking is that the Fed made no change to interest rates. Shock. Just shock. I'm ready for my winnings, sir, the line from Casablanca, saying that. And this is, do you ever wonder, the geniuses who go to Ivy League schools and other very good institutions get paid lots of money to write this kind of BS. This is what I knew I'd do it. Not Bernanke. That's how tired I am. This is what Jay Powell said. Uncertainty has diminished, but remains elevated. Really? What's the baseline for uncertainty? Would you let your 8-year-old get away with that line in elementary school in a book report? ChatGPT would probably write it, but your 8-year-old wouldn't. Uncertainty has diminished, but remains elevated. Okay, look, markets were essentially flat today. I think NASDAQ was up slightly, but the Dow, S&P 500 were essentially flat. I bloviate about all of that because it's a holiday eve. Tomorrow is Juneteenth. Markets will be closed. But I also want to pay attention to things that are happening with these markets because a lot of us are very worried that is 2025 a ticking time bomb for our investments. And there are lots of ways to invest money. And that's what our guests tonight are going to help us do. I want to introduce you to something that was new. It was launched in September of 2024. It's an ETF. It's the GammaRoad Market Navigation ETF. And year to date, it's doing pretty well. It's going to hit its first year anniversary in September. Now, when you have a tool like this, the tool is great for an investor, but there are people behind the tool. There are brains behind the tool that create the index that the tool is actually leveraging to help you invest your money. So we have with us the brain behind that index, and that would be Jordan Rizzuto, who is the CIO of GammaRoad Capital Partners. It's great to have you here, Jordan. Thank you, and you have permission to correct me every time I say Bernanke instead of Powell, and every other time I put my foot in my mouth. But it's great to have you here, and I hope you're having a good evening.
Great to be here. Thanks, Adam. Same to you.
So explain to me the index, how you came about creating an index that basically what you're trying to do here is align different variables so that the index can help me make decisions about investing. Tell me how you got there.
Yes. So the index that you're referencing is the Market Vector GammaRoad U.S. Equity Strategy Index. And we partnered with Market Vector to launch that index in December of 2023. And the index and the strategy underlying the index seeks to deliver total returns comparable to the S&P 500 over a full market cycle or over multiple market cycles. So it's really intended to be a long-term strategy. And it does that on the basis of 3 unique drivers of market risk for the U.S. equity market. And specifically, those 3 drivers are behaviorally based, which is consumer confidence. We've got one that is based on economic strength, which looks at cross-asset relationships. And then the third measure is a pure price trend measure of the overall S&P 500 itself. And so these measures are measured as either bullish or bearish for U.S. equity market risk. They're measured on 3 distinct time horizons. So the consumer confidence is measured monthly. The fundamental economic strength is measured on a daily basis. And the price trend measure is measured on a weekly basis. And these are combined to determine whether the strategy allocates to S&P 500 exposure, T-bill exposure, or some combination.
So the index right now, what is it telling people who are just paying attention to the index? What is it telling them they might wish to do?
So at the moment, the index is positioned with one of its three measures as bullish, so fairly conservative from a risk-taking perspective. The price trend measure is the sole bullish measure right now. And the story through the framework of these three measures is quite fascinating coming through 2025, the way it has unfolded. So if you recall, we came into the year really on the heels of a fantastic 2-year run in the S&P 500. And so we entered the year with the strategy's three measures unanimously bullish. And so the strategy was at its maximum equity exposure. In late January, our measure for consumer confidence turned bearish. And so the strategy reallocated to a third T-bill exposure and 2/3 S&P exposure. In mid-February, then, our measure for economically sensitive assets turned bearish, which is indicating fundamental economic weakness. And so the strategy reallocated again at that point to 2/3 T-bills exposure, 1/3 S&P 500 exposure. And then in mid-March, as volatility was starting to pick up, the price trend measure turned bearish as well. And at that point, all three measures were bearish, which means the strategy was allocated entirely to T-bill exposure. And so it was at 100% T-bills coming into and through the tariff tantrum and the volatility we saw in April. And then the rebound that we've seen, the impressive rally off the April lows, was sufficient by mid-May to turn this price trend measure bullish once again, at which point the strategy re-risked and took on a third S&P 500 exposure and 2/3 T-bills exposure.
When I hear about treasuries, I'm thinking of, I had a conversation, I was very fortunate, and I'm dropping a name here, but Rick Rule, who some people may know, who was telling me, man, if you're not, regarding treasuries, short only, beware, beware. But I want to read something to you. I follow her on X, Kate Long, who, when I was at Fox, I first met her, and she follows all kinds of investment strategies, but especially treasuries. And she just posted this on X. So by the way, if you're watching us on X, you can put your questions in for Jordan. We will make sure to ask Jordan your question. But Kate writes, foreign investors holding U.S. treasuries held close to a record high in April, despite the turmoil in financial markets in the wake of President Donald Trump's Liberation Day tariffs. Quote, the sell America narrative is an over-exaggeration. What do you think? I realize that we're talking about the index, but what Kate has just pointed out, it seems to fly in the face of the narrative that we keep hearing from what I like to refer to as the pontificators on CNBC and Bloomberg, and where the data becomes much more important. And your index is driven by the data, not the pontificators.
Yes. So rates and the shape of the curve are not an explicit input into our strategy. I think there's some mixed evidence in the data. I think, as we've seen time and again, the media narrative to a degree can be overblown. I would certainly keep an eye not only on the data that the Fed publishes in terms of holdings at the Fed, but I would also look at currencies and look at that as an indicator of capital flows. And we have seen some movement. We have seen some weakening in the dollar that can be suggestive of foreign investors leaving U.S. dollar-based assets. But it's been a very short time period, as you point out. And while the moves on a day-to-day basis may have seemed somewhat meaningful, you can squint at it on a long-term chart. So really remains to be seen from a market pricing perspective where that will shake out. It does identify a very important design decision that we had in developing the architecture of the strategy. And it goes back to the Rick Rule point you made earlier. And by the way, huge fan of Rick Rule. Love that you've spoken with him. Very insightful. I would encourage anybody watching this to find anything and everything that where he's been interviewed. But we had a choice, which was, well, if you're going to allocate to an alternative to S&P 500 exposure, and that's the strategy expressing the risk-averse part of the strategy. Traditionally, you would find that most conventionally based portfolios would look to long-duration treasuries. And they would do that on the basis of the last 3 decades, where we saw time and again that when meaningful equity volatility picked up, the long end of the curve provided diversification. In fact, that's the basis for how many conventionally built portfolios, 60-40 portfolios, balanced funds are built, right? They're predicated on this diversification benefit that the long end will provide if equities sell off. What we're finding in this environment, and really since 2021, is that as we've seen this upward pressure at the long end of the curve, you begin to see a change in the correlation between equities and fixed income, specifically treasuries. And in fact, in an environment like this, historically, the last 25 years are not the reality. That's actually the anomaly. And in an environment where you have significant upward pressure on the long end of the curve, you have increasing inflationary expectations, and you combine that with a weaker growth outlook, you can actually find that there's a significantly positive correlation between equities and long duration. And that's why we chose T-bills to stay, as Rick pointed out, as short as possible when you're not expressing equity risk.
So I want to talk about the index again, and how you designed this. And again, remember that I'm a Luddite. If I ask you a question, because there are compliance regulations, and I don't want to be hawking anybody's product, but I do want to mention this index. I want to hawk your index. Where did you get the idea to do this? Because you were an institutional investor, and you could have, ridden that to Easy Street for many years. Why do this?
Well, being on the institutional side and being the chief investment officer for a private foundation for a family office, working at a large corporate pension fund, you have the benefit of having quite a few investment strategies pitched to you, a ton of research coming your way, and a common facet or personality trait of so many of these equity-based strategies is that they are really designed to do well only in one part of the cycle, or in one type of economic regime, or under a certain set of capital market assumptions. And they become particularly vulnerable when you get these very deep, prolonged downturns like we've seen historically for the S&P 500, or really for any equity index. And so the motivation there was to bring something to market that can attempt to navigate that, and to do it in a completely systematic, rules-based, objective fashion. So there's no discretion involved here. There's no decision-making in a discretionary sense. This is entirely based on these three measures and their objective of measurement at any time. And it requires quite a bit of intellectual honesty with oneself, frankly, to put your faith in any one measure of how favorable the equity market might be at any point in time. Because one, it's a very, very challenging endeavor. And two, we're all built with human bias, right? And the more time we spend working on something, or the more time that we convince ourselves that something's a good idea, right? It's easy to convince yourself that research looks compelling when in fact it may be highly dependent on a specific market environment or part of the cycle. And so, the motivation here is to bring something objective, rules-based, that is repeatable and trustable over multiple market cycles.
Yeah, I tried to convince myself that canned sardines was the next big investment, but I was wrong on that. I want to take a quick break.
That's going to leave a bad taste in your mouth.
It's an old Saturday Night Live skit, sardines. Nothing says loving like sardines. Nothing says loving like, I was about to say Ben Bernanke, Jay Powell. And right. Okay, so we had the Fed heads and blah, blah, blah for 45 minutes, and all of the pontificators showed us how smart they are with the questions they asked. Here's what President Trump said about Jay Powell literally within the last 2 hours. Let's roll that soundbite.
We're doing well, and as a country, if the Fed would ever lower rates, would buy debt for a lot less. It's a shame. This guy, do you ever have a guy that's not a smart person and you're dealing with him and you have to deal? He's not a smart guy. Maybe I should go to the Fed. Am I allowed to appoint myself, Doug? I don't know. Am I allowed to appoint myself at the Fed? I do a much better job than these people.
I'm going to give you my opinion real quick, and then I want yours, Jordan. Look, I had the privilege of meeting Jay Powell when I was a reporter at Fox Business, and he was not yet chair, but he's certainly a smart individual. But as I've watched President Trump from the first administration and now in this administration, I think he's teasing people. I think he says what he just said, those kinds of things, to get a reaction out of people. I don't know if he truly cares. He cares about low interest rates. He would love low interest rates. But I think he says those kinds of things to get the pontificating class riled up and to go crazy, because Bernanke knows he's done in 26. What do you think? Bernanke, Powell.
Well, you caught it, so I didn't have to. That's fine. Look, it certainly provides for entertaining clips like that. I agree. We tend to stay away from politics, but I think the important thing for markets here is that it brings into question this whole concept of Fed independence, and it sort of underpins one of the ongoing parts of the narrative, really, right now, which is the favorability of U.S. assets, particularly for non-U.S. dollar investors, for foreign investors. And you touched on that earlier with rates and with Kate Long's commentary. And this is another aspect of that. I think a lot of the reason for U.S. exceptionalism in terms of asset price behavior and what we've seen over time, certainly through this cycle, and really over the very long term, expresses a certain faith and confidence in certain aspects of U.S. markets and the governance of U.S. markets. And if we move increasingly in a direction where we're questioning Fed independence, we could talk about the shadow Fed chairman concept as well.
Yeah.
This is sort of another potential knock on that confidence, right?
Well,
and confidence takes an awful long time to earn, and it can be lost very quickly.
It can be lost very quickly. We mentioned Rick Rule. And in regards to that confidence, I asked Rick a question when I interviewed him for something else. And it was a comment he made in which he does not expect the dollar to lose its reserve status, but he does expect the US dollar to lose its hegemony. And I asked him to explain what he meant by that. And he said, look, they're still going to transact in dollars, but our ability to lead is diminished every day. And the kinds of things that President Trump just said, or even people who attack the Fed, is that's what's chipping away at U.S. hegemony with the dollar?
I think to a degree. It's also important to recognize that, if you follow capital flows, you follow developments in the global currency markets, this trend or this movement to reduce the dependence on the dollar by non-U.S. dollar market participants, has really been in play for over a decade right now. I don't know that we have time to go into all of the details of that, right at this moment.
Sure.
But suffice to say that, I would agree with Rick at the headline level, in the sense that, something that takes decades to build up does not change overnight. I think we live in a very short-term reality these days, and so folks expect those things to change overnight. They don't. But we can clearly see, central banks outside the U.S., large institutions outside the U.S. taking slow but deliberate and meaningful steps to reduce their dependence on the dollar from an investment portfolio exposure perspective. But then also you see it economically, and you see, fiscal policy around the world increasingly moving in that direction.
So as I start to wind down with you, I want to ask you again about the index. People like me, and I refer to myself jokingly as a Luddite, but I think I'm a pretty average do-it-yourself kind of investor. Your index, will others start leveraging the index? Will you be creating other indexes to be leveraged so that we can take advantage of those should you go into partnership with those who can bring us the tools?
Yeah, so the long-term plan for our firm is certainly to do that. Appreciate the question. And, everything we will do will have certain common principles. First and foremost, they will look to mitigate or outright reduce risk. That will be whether it's applied to traditional beta exposures across asset classes, or in more of an absolute return sense to diversify traditional beta exposures in portfolios. And so some of the strategies that we plan to bring to market will be applicable in a publicly listed way. And others really will only be, applicable more under a licensing model and, in a private sense. Again, more of a conversation for another time. But certainly the long-term vision for our firm is to remain rules-based, to remain objective, and to bring these rules-based strategies to market.
And if people want to learn more about GammaRoad, what is the web address they should go to?
So the website is GammaRoadCapital.com. You can contact us directly through that website. So appreciate you asking. And we are happy to receive questions from anyone that has interest in the Market Vector GammaRoad U.S. Equity Strategy Index or any of the other research that we are working on now.
And I'm looking forward to the GammaRoad Adam Shapiro Canned Sardine Index for food prices. Jordan Rizzuto from GammaRoad, we really appreciate your being here. All the best to you. And perhaps back in September when the ETF hits a year, we can have you back for an update on where you stand with the index and where other indexes, if there might be a rebalancing or if you're introducing another one.
That sounds great, Adam. Thanks so much.
All the best to you.
Same
Before
to you.
I bring in my next guest, want to let you know that on July 2nd, we're going to do something special here. A lot of women, a lot of men, couples, married couples, go to fertility clinics in order to have children. And we have lined up on July 2nd an internationally recognized fertility doctor who's going to take questions from you that you might have about the procedures, the success rates, all of that. But the other thing that's interesting about this individual, and the story is starting to go public. They spoke at a conference in Las Vegas about 2 months ago. This individual, the doctor, was a sperm donor many, many years ago. They used to pay $75 a pop. And the individual was 36 years ago, donated. And 2 years ago, the byproduct of one of those donations found the doctor. The email that the doctor received was, "I'm ready to meet you." And we have the individual who wrote that email. They're both going to be on the program. So if you are looking as fertility as a way to help build fertility doctors, as a way to help build your family, there are things that these two individuals will share about the process of in vitro and egg donation and sperm donation, but also what this means for the human being who is created, who then may not know their biological mother or father, but then finds their biological mother and father. It's a fascinating story, and you get to ask both of them any question you want. I will share with you, here's the big tease, the individual who was the 36-year-old who found his biological father is well-known, prominent individual in the South, and people south of the Mason-Dixon line will know this individual. There's a connection to J.D. Vance. So how's that for a tease? I'm going to go back to the program now, but that program is July 2nd. We're going to let you know so that you can line up to ask your questions, because I know a lot of people have very serious questions about artificial insemination, in vitro fertility. It's a very important issue. Another important issue is housing. And when I first saw the opportunity to bring in our next guest, I was really thrilled to be able to grab this individual, because back in 2007, 2008, when I was with Fox Business, I was covering the slow meltdown of our economy, the great financial crisis, and what was happening with housing. You remember when the two Bear Stearns funds went belly up in the summer of 2007, then fast forward 2008, and there was a big press conference. You can go online, you can still see it, where Hank Paulson talked about, I think it was a $20 billion injection into Fannie and Freddie, Fannie Mae and Freddie Mac. And eventually they would be taken over by the U.S. government, which lasts to this day. So let's talk about what's going to happen with that, almost 18 years later. And to help us understand what's going on with Fannie and Freddie, we're pleased to bring into Talkenomics Tim Pagliara, who is joining us. He is the Chief Investment Officer at CapWealth. And Tim, thank you for being here and for putting up with my very bad jokes with Jordan about sardines.
Glad to be with you, Adam. Thank you for having me.
I start with that experience that many of us lived through in 2008, and I think people forgot that the U.S. government still has Fannie and Freddie in the terminology is conservatorship, correct?
Yes.
What does that mean, and why is that a problem?
Well, they were put into conservatorship under the Housing and Economic Recovery Act, and it was never intended to be a permanent situation. If they had rehabilitated themselves, if they did, the housing market rebounded, Fannie Mae and Freddie Mac rebounded along with it. And so the issue right now is, can the government operate the mortgage market better than the private sector? And I think, the answer to that is obviously no. Otherwise, JP Morgan, Bank of America, all the other banks that took TARP money, they're doing just fine. And Fannie Mae and Freddie Mac are different companies than they were in 2008.
But don't we need Fannie and Freddie, don't we, to keep the liquidity of the housing market moving forward? So the role they play is still necessary. That's correct, or am I wrong?
No, absolutely. This goes back to Henry Morgenthau and FDR, when the banks were in terrible, straits. And we didn't have a 30-year mortgage back then. The average mortgage was 5 to 7 years. And so when you don't have a job and housing prices are dropping and the Federal Reserve and the banking system is on you to raise capital and tighten up your balance sheets, people were getting thrown out of their homes. And so they had to do something to counteract the pro-cyclical nature of our financial system. And so they created the 30-year mortgage in what eventually became Fannie Mae and then Freddie Mac. And that has really been the bedrock of how we have been able to make housing part of the American dream.
But weren't the original concept for Fannie Mae and Freddie Mac is there are shares. Investors can buy shares in these entities, but there was the unannounced, or, and forgive me because I have forgotten 2008 except for the big headlines, there's the government guarantee that if something goes wrong, Uncle Sam is there to back it up. Is that accurate?
No, not really. There was a government guarantee, and policymakers in the 60s started looking at the tremendous impact that all of these housing loans were having on the federal balance sheet. Imagine that back then. And so they took Fannie Mae public in this public-private partnership with an implicit guarantee and government backing, so that they could get those loans off the books. And so the $7.2 trillion that is backed through Fannie Mae and Freddie Mac, that's not on the federal balance sheet. And certainly at this point in time, we don't need them on the balance sheet. And it's unnecessary. They've done a tremendous job. They've built 750 credit scores. They've got loan to value of 65%. Unfortunately, we have a shortage of housing today, especially for first-time home buyers. The situation is fundamentally different. And they have capital, and they have capital reserve requirements that they didn't have back then. Even Jamie Dimon today made a great comment. He said, Lehman Brothers wouldn't fail today because of the new capital rules and the way our banking system has been completely changed. And Fannie Mae and Freddie Mac are part of that as well.
So when we hear the Trump administration talk about the potential to take Fannie and Freddie out of conservatorship and go public, what does that mean? How does that happen? What would it look like? And if I'm an investor thinking, this might be because people will always want to buy a house, how do I get in on it?
Well, administratively, under the authority granted by HERA and following the Collins decision, the Fannie Mae and Freddie Mac, through the Federal Housing Finance Administration, is overseen by the president, the executive branch of government at this point. And so the government, as part of the unbelievable deal they cut in 2008, they own 79.6% of the outstanding shares of Fannie Mae if they exercised the warrants that went along with the package that they got for advancing money for losses. Now, during the Obama administration, they had a net worth sweep where they took 100% of their earnings and profits. And in 2019, September of 2019, Mark Calabria, under President Trump's direction, ended that net worth sweep and allowed them to start accumulating capital. And so they've been accumulating capital ever since. They've accumulated over $160 billion in capital at this point. And the value of the shares is estimated now in excess of $250 billion. So the government stands to benefit tremendously at a time where there aren't a lot of funds for housing. There aren't a lot of funds for discretionary spending. That money can be put better to use in anything other than staying stagnant inside Fannie and Freddie.
And if Fannie and Freddie were private, you mentioned the capital requirements. Who would enforce? Would it be the Fed, or would it be a different entity within the government to enforce the capital requirements to make sure that the loans that Freddie and Fannie are buying, that there doesn't become a buildup of loss that would then require another government step in?
Currently, they would be overseen by the Federal Housing Finance Administration and the United States Treasury with input from the Federal Reserve. So it's a combination of things that would establish what those capital requirements are, though. Interestingly, they have been through a number of stress tests over the last few years. And in adverse stress tests, just like they put the banks through, Fannie and Freddie operate very efficiently with 2.5% capital, which is much lower than what they're targeted for now, and they still make money. It's an amazing creation. It's the most profitable financial services firm in the world. One thing I'd point out too, that the American taxpayer benefits so much from Fannie Mae and Freddie Mac. They pay over $600,000 per employee in federal corporate income tax. That's the highest of any company in America. That's almost 5 times as much as Apple. JP Morgan, by comparison, pays $43,000 per employee. So these are great American companies that contribute in so many ways to our economy.
But before we started the program, you and I were having a conversation, and I brought up what's happening in the housing market now. It's shifting to a buyer's market, except in hot places like Miami. And parts of Florida, though, are in trouble because of the condo situation. That's another episode. In fact, we're talking about that next week with a real estate agent from Key West. But in your neck of the woods, Nashville, it's become a buyer's market. And Nashville is one of those hot cities where we're seeing companies from California move to Nashville. We're seeing companies from the East Coast go to Nashville. And yet, if it's a buyer's market, would that pose a threat to Fannie and Freddie if prices come down? Would that jeopardize their portfolios in any way?
Their portfolios are so strong right now with their loan to value and the credit scores and the average interest rate in their portfolios under 4%. And I think it's important to differentiate problems in the housing market. In Nashville, it's the higher end homes. It's the $1.5 million home and up that's dropping as much as 10 to 20%. So Fannie Mae and Freddie Mac, they serve first-time home buyers typically.
Right.
So that market, there's still a tremendous shortage. There's still tremendous demand. And until we increase the supply of housing for first-time home buyers, it's about as secure as you can get in the financial services industry, because no one wants to lose their home now, because if they do, they're losing a great interest rate. And at the same time, where are they going to go? So there's a lot of incentive right now that didn't exist in 2008 when we had this tremendous oversupply of housing everywhere.
I'm going to come back to the discussion about housing, because this is your specialty, and the Fannie Freddie discussion and the role it plays. But I promised that I would get your opinion. So we're going to run the soundbite again with President Trump talking about Jay Powell, President Trump presumably trying to pressure the Fed chair to get his colleagues to drop interest rates. Here's what the president said.
We're doing well, and as a country, if the Fed would ever lower rates, would buy debt for a lot less. It's a shame. This guy, do you ever have a guy that's not a smart person and you're dealing with him and you have to deal? He's not a smart guy. Maybe I should go to the Fed. Am I allowed to appoint myself, Doug? I don't know. Am I allowed to appoint myself at the Fed? I do a much better job than these people.
Tim, what do you think? Should the president keep the pressure campaign on?
Well, this is part of President Trump's style, and I don't. It's not my style; it's his style. Look at what he's accomplished, in less than 6 months. It's chaos, it's capitulation, and then it's compromise. And so I think he's, moving towards that capitulation and compromise phase in this discussion. And no, it doesn't. To your point in the top half of the program, Jerome Powell's a very intelligent man.
Yes.
And, and deserves respect. And,
yes.
And certainly, far be it from me or anyone else to challenge the independence of the Fed. And it's okay to have an opinion about rates. Everybody's got an opinion.
In the first part of the program, and I do have great respect for many of the people at the Federal Reserve, and it was a privilege to cover the Federal Reserve when I was a correspondent. But one of the things I mentioned at the first part of the program was the conversation I had with this guy, Rick Rule, who we talked about the danger of inflating our way out of debt. And we can talk about the $36 trillion debt the United States has. Mr. Rule, he brings in a much larger figure, $136 trillion, when you look at all of our obligations. But what he says is, by lowering interest rates, we essentially are defaulting without defaulting. We would be deflating our way out of debt. And my concern, if we lower interest rates, while I would certainly welcome it from a personal standpoint, is what does that do to the housing market? What does that do to Fannie and Freddie, which you've pointed out are in very healthy positions? Does it help them? Does it jeopardize them?
Well, higher interest rates definitely would maintain a much slower uptake in the housing market and the end of this shortage. So it doesn't help anyone. And, I think that the compromise that we're trying to find here, and I served on the committee for a responsible federal budget. Sounds like an oxymoron, till 2019, when the federal budget was under $20 trillion, and I was upset about it. But the compromise here is we didn't get ourselves in this position overnight. Tariffs will be a source of revenue. Economic activity will be a source of revenue. The threat of stagflation, which is what you're talking about, has to be dealt with. I was in a small group meeting with Treasury Secretary Bessent that Senator Haggerty sponsored at the end of March, and they have a plan. They have a plan to increase demand for U.S. Treasuries, increase the supply, and I'm very confident in their ability, especially Treasury Secretary Bessent's ability to guide us through this problem.
What you just said, and I know we're talking about Fannie and Freddie, but the question I'm asking, I'm in New York City. My friends refer to it as the People's Republic of New York, but I always point out, no, the People's Republic is California. We have not elected a socialist yet. We probably will, but that's another story. But when we talk about the administration's policies, what if the administration's getting it right? We were fed a diet from people opposed to what's happening of doom and gloom. It's going to raise inflation. It's going to destroy the economy. And even, I was about to say Bernanke again, even Jay Powell today said, we're not sure yet of the impact on the tariffs. But we haven't seen the dire impact as of yet. And we are now 6 months into the administration. Would you be willing, you just said Bessent and the team have a plan. What do you say to the naysayers about the administration's plans? Because those same naysayers, I'm sure, will oppose efforts to take Fannie and Freddie out of conservatorship.
Well, everybody has an opinion. The naysayers, for whatever reason, the Jim Parrott crowd, for example, and the Zandy crowd that are against taking Fannie and Freddie out of conservatorship, it's only because they wasted the opportunity in the Biden administration to do it. And they've lost control over that narrative. And so you just have to believe that they're going to make the right decision for the American people, for the American taxpayer specifically, in guiding us through this. And I think that the tremendous amount of gain that Fannie and Freddie can provide to the U.S. Treasury and the benefits that they continue to bring in. I mean, we need a lot more companies paying $600,000 per employee to the U.S. Treasury. So, let's let them run under appropriate capital standards and good management and see what we can do to restore the American dream of home ownership.
That $600,000 figure, I would love to explore that, because I'm sitting there thinking, wait a second, where's the data coming from for that? Real quick, if someone wanted to verify that number, where should they go?
Bureau of Labor Statistics, it's there. Walmart, 2.1 million employees, $1,500 in corporate income tax.
Okay, all right.
You can break it down.
I see. I get it.
By year. Yeah. So we've got it.
So let me ask you this, because you have access to individuals who are in the know. You are in the know. I suspect you're probably as wise as Jay Powell. What are the likely? Don't shake your head. No. What is the likelihood? Do you think that we will see that Fannie and Freddie come out of conservatorship this year or next year?
Very likely, and I think that they will execute the plan. President Trump, has made very positive statements about exiting conservatorship, and for the naysayers, probably the best thing they could do to help this along is tell President Trump that he can't do something that has to wait to the next administration. So
Yeah.
I think it's going to happen, and we're in a different place than we've ever been with this issue. Everything's come together finally.
It's interesting. There's a quote. There are two parts to this quote, but I love this quote, that a conservative is a liberal who got mugged, and a liberal is a conservative who got arrested. I would probably be the conservative who was a liberal who got mugged. I hope that the policies we've been talking about do bring about the kind of transition in our economy that benefits a great many people as opposed to the upper income, because that's what I think is behind the momentum here in New York City for an individual who could very well wreck the local economy. But it's hard to get people to see when we talk for this conversation that there is a benefit to all and not just the asset holding class if we were to bring Fannie and Freddie out of conservatorship. What would you say, again, I'm going to use the term naysayer, what would you say to them? And then I'll let you have the last word.
I'd love to tell Elizabeth Warren that back off. The federal government and the American taxpayer own 80 to 90% of Fannie Mae and Freddie Mac. So yes, are there shareholders that are going to benefit? Absolutely. But, look at what Winston Churchill said. You can always count on Americans to do the right thing after they've tried everything else. And we are at that point where this is the right thing. It benefits everyone. And there's no sense in prolonging it. I hope the president will act.
My favorite second quote is for people who are absolutely opposed to the Trump administration. It's a very simple question to ask. What if they're right?
Exactly.
Tim, is there anything you want to close with?
No, thank you for being on the show. Being on your show. This is a difficult topic. It's gone on for 17 years. There's a lot of nuances to it, but like I said, we're at that point where I think everything is aligning for a good outcome for the American taxpayer, the American homeowner, and the housing industry.
Tim Pagliara is not only a shareholder in Fannie Mae and Freddie Mac, but he is also the CIO at CapWealth. We appreciate your being here. Look forward to having you come back, especially when we get ready for this to happen and become reality, so we can talk about why investors should consider getting in on this. All the best to you, Tim.
Thank you, Adam. Have a good evening.
You too. And real quick, I had told the team here who are rooting for the Florida Panthers, they're hungover today because they won yesterday, the Stanley Cup, that I was not going to do a My Talk, but I will do a quick My Talk. And it has to do with something I just said to Mr. Pagliara, which is, what if the administration is right? We're 6 months into this administration, and I share the same concerns, and this isn't Democrat or Republican, left or right. This is somebody who's in their 50s, who grew up in a world of globalization, and I believe in the benefits of globalization. I believe that the United States and China being coupled together was a positive for the United States, but I have to be able, like other people, to step back and say, is decoupling perhaps at this point in history the right move for the United States? I don't know how to answer that question. Rick Rule knows how to answer that question. Chris Balding knows how to answer that question. But I think people who are middle of the road, who want the best for the United States and want the best for everybody in the United States, not the upper income asset holding class, but the people who missed out on globalization. What are the policies and will they work? And so the pontificators, who I love to attack now, I used to be one of them when I was on TV, and now I'm not, so I get to throw the mud. But the pontificators keep telling us doom and gloom. And all I'm saying is, what does the data tell us? Because the data so far, and we're only 6 months into the administration, and there has been upheaval, that is clear. But what is the data telling us? And so far, inflation's coming down. I am worried about jobs, but I work in AI, and I think anybody who doesn't should get ready. And I hope it doesn't come from my job. But inflation's coming down. Interest rates are high. But those of us who are in our 50s remember when our parents were paying 6 or 7% mortgage rates. I mean, there was that period in the 20s where they went up to 16%. But that, Paul Volcker brought them down. So what if they're right? That's how we're going to end tonight. What if these policies, the Treasury Secretary, Mr. Bissett, what if the Trump administration policies with the tariffs? I personally don't think the tariffs are the right way to go. But what is the data telling us? We should be driven by the data when we make decisions and not our confirmation bias, as we talked about at the beginning with Jordan, or our emotional reaction to things, as we were just talking about with Tim. Have a wonderful Juneteenth. We'll see you next week here on Talkenomics.